Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's global macro update, we are going to go through dozens of charts from across global macro. We're going to look at rates, Bitcoin, equities, foreign exchange, commodities, and cross-asset relationships so that you can get a better understanding of what is going on in the world. All right, let's give ourselves a little reset across the four main asset classes that we track here at the Bitcoin Layer: Bitcoin, stocks, rates, and gold. Now, Bitcoin and gold are neck and neck trailing 12 months right now, both up about 40%. Looking back 1 year, you can see that in green, stocks at 106, just a 6% return looking back 1 year, and U.S. Treasuries trading slightly above par relative to 1 year ago at 102. But with gold on an absolute tear this year and to close last year as well, we can see that gold has actually set the pace across global macro for the last 12 months. Bitcoin had its run toward the end of 2024, but you can see here that over the last few weeks and couple months that gold has caught Bitcoin, ran past it, trailing 12 months, and is right now out there setting the pace. One quick note on gold. The world is changing rapidly. The monetary system is on watch for a complete reordering. Some are calling this Bretton Woods 2, Bretton Woods 3, the Mar-a-Lago Accord. It's going by many other names, but what we are trying to explain to you guys at home is that the world's monetary system right now is in a period of either transition or pre-transition. When we think about what is going on right now with the reordering of trade relationships around the world is putting into the psyche of investors everywhere that the current dynamic in which the United States is in a perennial trade deficit to the point where there is so much US dollar capability outside of the United States that ends up in Treasuries and in US stocks, that system must see a big change going forward. That is policy. Now, if we think about what it will do if there are less dollars being exported and less U.S. assets being purchased by foreigners, what that means is that the prices of stocks and the prices of U.S. Treasuries themselves are on watch. And so where is some of that capital ending up, or where is it going? We can see that price action in gold. Now, because gold is physical and it doesn't have a blockchain that we can track activity, it is actually more difficult for us to understand how gold is moving around the world and through the financial system than it is for Bitcoin or Treasuries, for example. And for that reason, narratives around gold in terms of the specifics of who is buying and why are hard to come by, and we just have to do our best through time reading and researching, interviewing people that are in the know, what is moving the gold market and who is moving the gold market. But what we can do is observe the price and back into our own understood narratives, and it is global monetary reordering that is driving our understanding of the gold price. I would absolutely suggest that viewers and listeners go check out U.S. Treasury Secretary Scott Bessent's speech that he made this week at the IIF about the World Bank and the IMF, the United States' role in these two financial institutions, their original motives and where they came from, the Bretton Woods Agreement, and the explicit recommendation and policy pivot toward a restructuring of these two institutions. They are not serving the purpose, per Secretary Bessent, that they were intended for. And in this spirit, also, we can start to understand a little bit more about what is happening to the gold price. The gold price is responding to a reordering of trade relationships around the world. So please go check that speech out. We will have much more analysis for you guys. Don't forget to subscribe at thebitcoinlayer.com/subscribe. Become a TBL Pro. Gain access to all of our quantitative research and my personal letter that I send out. TBL Pros will be hearing much more about the Besant, Myron, Trump economic agenda. The loudest voices in crypto, finance, and economics do not understand Bitcoin. Join Parker Lewis and Dhruv Bansal for Bitcoin Not Crypto, a 3-part masterclass that lays out why 21 million is the key breakthrough and how Bitcoin, not blockchains, creates decentralization and why everything else will be built on Bitcoin. Understand why Bitcoin works and why nothing else does. Register now at unchained.com/TBL. That's unchained.com/TBL. Back up your seed phrases in titanium. Stampseed is a DIY titanium seed plate provider. They offer their own hammers, seed plates, and the tools that are required to hammer your seed phrases into titanium. These plates are rust-proof, fireproof, and they stand the test of time. Stampseed is now offering customizable titanium seed plates. Upload your logo or design, and they will laser engrave it on the back. A secure backup that is uniquely yours. Make it personable, make it unforgettable. Stampseed.com. A quick Bitcoin price check. We see Bitcoin right now trading right around the mid to low 90,000s. This is after a nice move up above the 89,000 level that we flagged for you guys, as well as flagged that bullish divergence. Now, Bitcoin is up against its short-term holder realized price, and it is just above its 200-day moving average. You can see the 200-day in red. It's increasing, meaning that Bitcoin is trending well. For Bitcoin to fall below that 200-day and recapture it after only a few weeks is a nice bullish sign from the price, but we want to see Bitcoin hold these levels, and we also don't want to see the second derivative of the 200-day turn negative. That means we don't want to see that red line roll over, go flat, or even, dare I say, turn to a negative slope. That's what we want to avoid if we want to see this bull market continue. Market value to realized value, MVRV. This is a relationship that we watch very closely. It's the relationship between Bitcoin's price, which is the price that we see on exchanges, versus its cold storage price. That's the way that we describe realized price, because what realized price measures is the on-chain price at which Bitcoin last moved. And when we compare these two levels, we get a ratio, and that ratio you see on the bottom pane at 2.12. This is a fair value type of ratio for Bitcoin. When it gets to levels in the 3 to 4 range, that is when Bitcoin is overheated. It's overheated because the price on the screen is starting to distance itself from the price at which those Bitcoins were acquired and tucked away. We're not talking about traders. We're talking about investors that buy Bitcoin on exchanges and then move them on the chain to cold storage. That is the way we've thought about realized price for the last several years, but now with the advent of ETFs and the enormous wave of corporate treasury buys of Bitcoin and strategies that are being rolled out from corporations, we need to start thinking about realized price a little bit differently than cold storage price, but more in terms of the long-term holders' realized cost basis, right? The cost basis is the price that they purchased it. The higher the ratio goes, the higher the green line goes, the more profitable all of those positions that are sitting tight are. And so if the positions are sitting tight and at a modest profit, they might stay there. If the position gets into an extended profit, meaning a ratio of 3 or 4, it's more likely that the long-term holders come and join the market and sell. We call that hitting the bid. And so when will these investors hit the bid? When the price is expensive relative to where they got in. And so those stretched valuations are what are the most dangerous for Bitcoin and actually the most likely to cause a bear cycle. With Bitcoin reaching 3 on the MVRV twice during the last year, once in the first post ETF melt up during Q1 of 2024, and then right after the election of Donald J. Trump, 45-47. You see that the Bitcoin market value to realized value ratio gets capped at around this 3 level. And it doesn't have a cascading bear market type of behavior after it reaches that. It means slightly overstretched, slight profit taking. And I say slight because when you relate it to Bitcoin's past, you can see that this is actually muted price action. So how can Bitcoin's current bull market extend itself? Simple, not get overstretched on its valuation. And so with Bitcoin trading around 2 on the MVRV, we like that. We are very comfortable seeing Bitcoin even just keep this level. And what will drive the red line higher, the realized price higher? More holders coming in and taking those coins off of exchanges and into custody, whether it's with custody platforms or their own cold storage. That will drive the red price up. It drives the base valuation of Bitcoin up, and it gives the price more room to run. A quick look at ETF flows, and you can see here that this week with the bullish price action of Bitcoin, this little breakout that we've had above 89,000, that you see one of the largest days in Bitcoin ETF's young history of inflows. Now, this is an interesting one, Bitcoin versus the S&P in terms of correlation. You see on the top pane the two prices. But the middle and the bottom pane, these are the 40-day and the 100-day rolling correlations. And you can see in red and also in navy here that correlations between Bitcoin and stocks are still elevated. Yes, we get days where the two don't move together or they move in opposite directions. And these can actually create these periods where there's strong correlation but brief decoupling events. They can actually create an enormous range of returns. You saw there that trailing 12 months, Bitcoin's price is up 40% while stocks are only up 6%. So the range can be quite wide in terms of the returns, but correlation doesn't measure returns. It measures variance of returns. And so when Bitcoin goes up and stocks go up, that's a check mark on the correlation graph, no matter what the return was on that given day. So what the takeaway here is that Bitcoin and stocks are still joined in a relationship. That relationship has a lot to do with liquidity. And by liquidity, I mean TBL liquidity, the way that we look at it. Asset-based liquidity, the ability of banks to create credit and to make markets. Liquidity is dominated by the size of the banking system, the price of treasuries, the volatility of those treasuries, and general market making ability, which is also influenced heavily by the US dollar. A quick look at Bitcoin volatility on a realized basis. This means looking backwards, the last 30 days. What is the variance of those returns? You can see that in the first few years of Bitcoin, extreme volatility relative to today, right? The last few years, it's just more quiet. And if you look at 2022 even, Bitcoin volatility right now, generally speaking, is lower than 2022, lower than 2020. Look at the volatility during COVID, right? You had one of those days Bitcoin went down by 50% in one day from $6,000 to $3,000. And so imagine Bitcoin going from 94,000 to 47,000 in one day. That's the type of volatility that we seem to have separated ourselves from. And that's a maturation of this asset class. All right, let's take a longer term look at our metric, TBL liquidity. Remember, this metric is asset-based liquidity. It measures the size of the banking system on the asset side. It combines that base with treasury prices, treasury volatility, and the level of the US dollar. Lower rates, lower volatility, and lower dollar are all magnifying effects on this index. So when rates go down, when vol comes down, and when the dollar gets weaker, these will all boost TBL liquidity. thebitcoinlayer.com/subscribe to become a TBL Pro and get access to all of these reports as they come down. Now, Bitcoin's behavior is influenced a lot by TBL liquidity, as is the stock markets. We've proven that to ourselves with our empirical correlations. What you see here is that over the last few years, since 2022, mid-2022, liquidity has climbed. That's because rates have fallen and the uncertainty has also fallen. Now, over the last few weeks, we have seen a dramatic spike in volatility and interest rates that has sucked liquidity out of the system. But the bounce that we've had since then, the last few trading sessions with bond volatility coming down, as well as the dollar coming down quite a bit, these have supported our index and are therefore supporting the risk markets. Now on this chart, it's a much closer look at our liquidity index. We've shown you Bitcoin as well here. So you can see the purple line that bounce over the last few trading sessions as it really reached levels that were a little bit close to neutral on our index, meaning that actually a drag on general liquidity. But the bounce is a welcome bounce, and we see that Bitcoin's price has responded. In this next chart here, it's our TBL liquidity index versus the stock market in green, and again, you can see that relationship. And the last one on TBL liquidity versus the MOVE index. This is bond volatility. We have that red bond volatility inverse there on the right side of your y-axis. That means that as liquidity goes up in number, it'll go down on this chart, and as it goes up in number, it is a drag lower on liquidity. And you see that the recent event, that event where the red line comes crashing down below that 50 level in the middle of the screen, that move higher in bond volatility, which is lower on the chart, that was the event that really knocked stocks and all of risk off of its feet over the last few weeks, right? The uncertainty, the wave of uncertainty came flooding into the market, and it hit all risk assets. Now you can see that bond volatility has softened, which means the red line is up a little bit, and that is the main driver of our liquidity index higher. So hopefully over these last few charts, you've gotten a little bit of a better understanding of what our metric is, what we are trying to accomplish with this metric in terms of where are these risk markets going and why. That's what we really care about, and what we believe you care about at home. You care about whether markets go up or down, and you also care about why so that you can understand it. So that's our mission, and that's what is driving our research at the Bitcoin layer. Now, the liquidity metric that is most commonly used that I see out there is M2. Now, M2 is a measure of liabilities, not assets, and those liabilities are basically deposits, so they don't capture shadow money. So I don't think that M2 is a good leading index in terms of what is moving markets. However, it will, because it's on the other side of the balance sheet that we are measuring. It's the other side of the balance sheet, which means that it's going to look very similar. But as you can see in this chart comparing liquidity, TBL liquidity versus M2, which is in navy, you can see that the relationship, it holds, meaning they go up and down together. But you can also see that the purple line is leading and the blue line is lagging. And because the blue line is lagging, we are more interested in the purple line, which means the asset base, but then with our multipliers, which are market metrics that move every day, we get a better sense of where that liquidity is going generally. So that's why I wanted to show you M2 and show you that relationship that we're trying to get ahead of it. Not that it's a bad metric to measure in terms of what might be out there moving the markets. But what we do is we try to look before M2 is created. And M2 is a liability, so therefore we have to look at the asset side. Now, this next one is the term structure of interest rates, or also known as the yield curve. The yield curve has steepened quite a bit over the last 1 month. We see the thin red line being the yield curve 1 month ago, and the thick red line today's yield curve. And as you can see, yields in the longer end of the curve have moved up significantly, while in the short end of the curve, they've stayed somewhat the same over the last month. That is what is called a steepening of the yield curve. The steepening of the yield curve in this case has been due to both a decline in 2-year yields and an increase in 10 to 30-year yields. So it's coming from two directions. This is also called term premia because it is the price, the premium that you pay for investing over the longer term. And so the term premia has increased. It means that there's more compensation that investors are demanding to lock their money up with the U.S. Treasury. If we think about what we discussed earlier in the show about gold and the reordering of the monetary system, and specifically the U.S. desire for foreign countries to hold U.S. Treasuries, that desire has started to decrease. It's also being communicated to the market. Remember, Treasury Secretary Bessent, Chair of the Council of Economic Advisors, Dr. Stephen Myron, are out there in front of the public delivering speeches explaining the entire agenda behind new trade relationship negotiations. Part of that negotiation is, hey, you need to hold less U.S. Treasuries in reserve. Not none, but less. And maybe that less Treasuries being held are targeted more for certain countries than others, right? We think about China. But in general, if the U.S. is trying to reshore and is trying to build back up its industrial base, and it is trying to sell more weapons to foreign allies, in those scenarios, the amount of dollars exported declines, right? It declines if the U.S. makes more stuff, and it declines if we sell them more weapons. And so if that exporting of dollars declines, the holding of U.S. Treasuries abroad also declines. The U.S. Treasuries held abroad are across the curve, but yes, a lot of the long-term debt that the U.S. government has issued is owned by central banks around the world. And so those central banks and those finance ministries and those sovereign wealth funds that hold all of that long-term debt, they have been put on watch that your current system of stockpiling treasuries is not the path we would like to see going forward. And so the U.S. has a tricky game to play here. It's explicitly telling the rest of the world, hey, you shouldn't hold as much U.S. Treasuries, and we actually will not be exporting you the dollars to do so. But the U.S. government also does not want its rates to go up, right? It wants rates to be low to help it finance its deficits, because it's not like the U.S. government is turning into surplus anytime soon. And so when we think about all of these things together, it makes sense that we've seen a steepening of the yield curve. I'm going to show you a chart a little bit later about the components of 10-year Treasury yields and a little bit more about why I think this. 2-year yields, remember that 2s are a forward-looking Fed funds rate. We can see them in decline over the last couple years, and that trend of lower highs continues to hold. We continue to see 2-year yields trending toward 3%, as well as the policy rate trending into the 3 to 3.5% range. The U.S. economy right now is going through a slowdown. It is self-inflicted in many ways. Number one, the amount of government spending is going down. The current administration, I think about this quite a bit now, that before all of this trade war, before anything else that they did, the very first thing that they did was they cut USAID. And what they did, they demolished this agency because it was sucking money out of the U.S. Treasury Department, basically a blank check. And so if that was the first policy, you automatically start to slow down the economy if you actually cut money off that's going directly funneled into Washington, D.C. Then we saw a spike in home listings in D.C., a spike in unemployment in the Washington, D.C. area. And so we actually know on the ground, we have data that D.C. itself is being cut off from some of its funds. And so that by itself is going to affect the U.S. aggregate demand. Also, you have targeted job cuts in the government. Now, we haven't seen the actual line item of spending come down, but we have been told that the current budget is still of the previous administration, and when we actually might see cuts is sometime starting in September, October. It's also what we've been told by Secretary Bessent that some of the deregulation will be coming online in terms of the Treasury Department taking back control over some of the banking regulations and actually remove some of the restrictions put on banks by the Fed and the current U.S. banking regulating complex. Couple that with the uncertainty that comes from a reordering of trade relationships, and not to mention massive tariffs put on our large trading partner in China. And so if so many U.S. companies are completely dependent on Chinese supply chains, what do you think that those tariffs are going to do to that type of purchase manager? That purchasing manager is going to seize up because they don't know what they should be spending on. They don't know if they have to reorder their supply chain. They don't know if they can afford what the import duty will be or the new price that China will put on this product that is now tariffed. And so for all of those reasons, we can expect the economy to slow down. And that slowing in the economy will be delivered to the market in terms of signal through the Treasury market, specifically the front end of the yield curve, which leads the Fed. On 10-year notes, you can see that the yield, while we still have some lower highs, the end of 2023 and this beginning of 2025, you had a lower high, close to 5 and then close to 4 3/4. You don't see the same shape of rolling over as the 2-year part of the curve, and that's that yield curve steepening that we've been talking about. Future growth and inflation expectations coupled with term premia are all elevated relative to the front end of the curve. Obviously, the front end of the curve doesn't have any term premia, but in terms of the current growth and inflation expectations, it's mirroring where the Fed wants to go, which is lower. There's also a worry that the tariffs will cause simultaneous contraction in growth, but a spike in inflation. I take a challenge to that. I don't believe that that is the path forward. I believe that growth and inflation expectations should come down together. And in fact, per the market, that is exactly what we are seeing. On the screen, you have 10-year break-evens. These are calculated by taking the 10-year yield and subtracting the 10-year TIPS yield, which is also known as the real yield. So real yields plus inflation break-evens equals our 10-year yield. And you can see that the break-even component of 10-year yields has not increased. That means that the market is not expecting higher CPI coupons from TIPS, which are real yields, are also known as inflation-protected securities. You get that real yield plus the CPI look back. And that CPI look back assumption is what this number is. And so going forward, the CPI add-on to a Treasury inflation protected security, or TIPS, is just 2.25. So there's no inflation in the market. And I'm not trying to exaggerate. This is the inflation metric for the market. There is none. Now, you can see that wasn't the case during 2021 and 2022, where the inflation component was going up and up and up because inflation was getting worse and worse and nothing was being done to stop it. But then something started to be done to stop it, right? Rates got to 5.5%. Then you saw it come down, and it hasn't gone back up. Now, realized inflation by CPI is also telling this same exact story. Now, I know the tariffs haven't gotten into the economy yet, but I believe that the substitution effect will dominate, and it will not be supplanted by these Chinese tariffs. Chinese tariffs might increase prices throughout various points in the economy. They also might drag inflation up on the aggregate. But to spur on a broad inflation worry in the market would have already told us that. And actually, inflation break-evens have come down. Why? Because growth is slowing, right? A self-inflicted growth slowdown is occurring. And so I believe that inflation break-evens will reflect where the market believes inflation is going, and right now, somewhat muted. This is one of those charts that will motivate the Fed to cut, we believe, as it potentially ticks up here over the next several months. Unemployment at 4.2%, and the Fed will definitely be looking at an unemployment rate at 4.3 to 4.4% and starting to worry. It will cause the Fed to continue on its cutting path. And actually, we believe that it'll probably coincide with the Fed's cuts in June or July. And so with what we talked about with DC, what we talked about with uncertainty in the economy, we should see unemployment start to tick up. And remember, that is a trend that has been with us for quite a while. Remember that we were on recession watch ourselves during 2023 and most of 2024, as it looked like the economy was rolling over due to these 5.5% yields. But it never dragged economic growth below zero, and it might or it might not. But what we see here is an impetus for the Fed to cut due to higher unemployment. CPI, this is the realized CPI. Looking back right now, 2.4% on consumer price inflation. That is really just a much lower level than anything that we had over the last several years. And so the Fed is quite happy with this. It does believe that it's taking this level back down to 2%. Even if you or I don't believe that they certainly believe that they are. And it is going to let them cut rates, because if this number was 3 or 3.5%, the balance between a weaker economy and higher inflation, it wouldn't tip in the scale of rate cuts, but this one does. So look for that Fed rate cut cycle to continue, perhaps June, that we'll see the next cut. ISM services, what we see on ISM services, 50.8. That's a very neutral reading. It means the economy is not doing much right now. So when we talk about this level going below 50, as you see that it did twice during 2024, the summer of 2024, we were not only on recession watch, we had ISM below 50. And so that is a brief contraction of the economy there. And it just didn't show up in GDP. Now, we see that level back down. And so, yes, you have to be thinking about what is happening to the U.S. economy. It's definitely slowing. And we'll be watching to see if this comes down below 50. Because if it does, that means that you have broad responses in the surveys that say, hey, I'm doing less this month than I was last month. I'm hiring less. We can already see services employment is at 46. That means they were firing people last month, right? They were laying people off last month. And so if that continues, a labor force that's being laid off is going to slow down the consumer, which will slow down the economy. So all of these things we'll be watching for. We are of the belief, from the political, cynical side, we are of the belief that a good economy in the second half of 2026 is probably the most important thing for the current administration, politically speaking. And if so, if 2026 is the priority, then 2025 can be a bad economic year, and they will politically potentially get away with it if they have a good 2026. So that's one thing to keep in mind. On the manufacturing side of ISM, you see that ISM headline is at 49 for manufacturing, again in contraction, but that's nothing new. If you look back at the last 2 years, ISM manufacturing has been in contraction for the last couple years. This is hollowed out U.S. manufacturing, not necessarily a weak U.S. consumer, because the weak U.S. consumer would have hit services too, but services were doing fine, if not for a couple months during 2024. Here's a chart of gold. You can see the parabolic move. Looking a little bit closer at the candles, gold might have hit a little bit of a blow off top when it tagged 3,500 earlier this week. That's something to flag. I've looked at the chart. There's a trend line that's coming up to around 2,800, 2,900 or so. So for gold to have a pullback, it would be somewhat expected, and I'm sure that you're going to have some profit taking in the gold market. Now, the asterisk there is that you are in a monetary reordering era, and so we have to think about that as well. A quick look at the money markets. We're looking at SOFR here in orange. Now, these straight lines across the screen, these are the Fed's policy rates. When the Fed cuts rates, it's lowering its policy floors and ceilings. That's its corridor. What it's trying to do is guide repo. And so it guides repo by setting these ceilings and floors, because the arbitrage in the market looks to, for example, the interest on reserve balances and says, if that's the lowest rate I would get from the Fed, I wouldn't lend in the repo market for less than that. So it keeps repo above. The discount rate you see at 4.5%, if a bank gets in trouble, they can just go to the discount window. And why would they need to go to the repo market at a higher level? And that keeps repo rates capped at the ceiling. And so right now you had a little spike in SOFR over the last few weeks during the troubles during the bond market volatility of April of this year. But what you see now is that levels have come back down. We're looking at debt to GDP here. That's on the top pane in red. The debt and the GDP themselves are on the bottom pane in green and in navy blue. In green, you have the debt, and in blue, you have the GDP. And that is the gap that needs to be closed. That is what the government is trying to do now. Close this gap, raise GDP, and keep debt from rising. And even potentially reduce the overall debt. But while we don't anticipate that they will reduce the overall debt and actually send that $36 trillion number lower, they do want to try to increase the GDP as much as possible and stop the green line from going up. And in that way, cap this red line and start to send it lower. And only by sending it lower can the U.S. get back on a path of fiscal sustainability. Because right now, where rates are, especially in the long end of the curve, and with the amount of deficit that we are continuing to roll over each and every year, it is not sustainable. And so interest rates have to come down, the deficit has to come down, GDP has to go up. All of these things must happen for the U.S. to get back on a path of sustainability. And so that's what we will look for the administration to try to accomplish. This is twos versus Fed funds. We've talked about twos leading Fed funds. This is what we're talking about. You see that in 2024, the bottom pane, the green bars get deeper and deeper negative. That preceded the first rate cuts. Now they're getting deeper negative once again, and that will precede more rate cuts. So this is what we watch, and we know this to be leading. Sometimes it's very early. Like, look at the beginning of 2024. That was saying rate cuts, but it was almost a year early. So yes, it can be very early, but it probably won't be wrong. So that's why we continue to watch this. This is the chart I was telling you about, the contributions of yield. So you see 10-year yields in purple there at 4.4%. It's the sum of these two levels. The green, which is TIPS, Treasury inflation protected securities, and the red, which is the inflation break-even component. So you see 2.11 plus 2.29 equals that 4.4. So you can see when yields move up, what is the cause? Well, it was the green line, not the red line during the last spill in Treasury prices when yields went up. And so that means it wasn't an inflation scare. It wasn't. It was a selling of Treasury securities, a higher premium that is being demanded, the real yield, a higher real yield that's being demanded to own them. And so that means it was a problem in the Treasury market, not with inflation. And that we have to look at the market for those types of signals. Really interesting to see here that Bitcoin is now almost 2.5% of global equities. This is looking at the Bitcoin market cap as a percentage of the FTSE all-world market cap. And so Bitcoin now threatening this 3 to 4% level. We're talking about Bitcoin now eating the equity market slowly but surely. It's really fascinating to watch. And as Bitcoin climbs to 3, 5, and 10 trillion dollars, the size of Bitcoin relative to other asset classes is going to raise some eyebrows. All right, last chart for you guys, the U.S. energy picture. What I have for you in orange is U.S. crude exports, and in green, U.S. crude imports. And what you can see here is over the last decade, imports have steadily declined, exports have steadily increased. Therefore, our net import is negative, which means we are net exporter of energy. The current administration would not only like to see this continue, but to accelerate. And that will only come from the orange line going even higher up. And so deregulation of the energy industry, the desire to electrify the country to the tune of 3 times the current baseload generation capacity that we have. And the speech from Bessent this week that said the U.S. wants to sponsor developing countries to borrow from the World Bank so that they can establish baseload energy production using fossil fuels to help them industrialize and get out of this trap of solar and wind that is intermittent and doesn't allow them to industrialize at all. And this is a huge trend that we have to continue to watch. The energy sector itself, I believe, is ready for a big boom over the next few years as not only the United States gets electrified to set up for the coming boom in AI and the AI compute that we need from all this generation, as well as the buildup of other countries and their baseload power generation. Thanks for sticking with us today. Make sure you catch us at thebitcoinlayer.com/subscribe for plenty more research on Bitcoin and global macro. Like this video, subscribe to the channel, subscribe to us on your favorite audio platform, and we'll catch you guys next time.